projects and the kind of various angles of investor interest in this particular asset class. I'm going to start by introducing, firstly, the Assistant Minister for Climate Change and Energy, Josh Wilson, who's also the MP for Fremantle, who is here as our most senior representative of the Australian Government for the first week of COP29. Then I'll come back, we'll call our esteemed panel up, I'll introduce them, and then we'll have an interesting discussion. So very much looking forward to it. So please welcome the Assistant Minister for Energy and Climate Change, Josh Wilson.
Thanks, Ian, and good afternoon, everyone. It's great to be here in the Australian Pavilion. It's great to be here at COP29. I'm going to say Kaya, which is how we say hello in Walyalup in Fremantle, the lands of the Whadjuk Noongar people, where I'm from. And I'm not going to speak for very long because I want to hear from our panellists on a very important topic. While we focus on tackling dangerous climate change, I think it's always important to remember that broad sustainability agenda, and we need to find ways to make sure that we join up what we're doing on climate with what we should be doing when it comes to environmental condition and biodiversity, and what we should be doing when it comes to the circular economy and the impacts of plastic pollution and other kinds of unsustainable resource use and management. I think while we do that, we do need, as much as we can, to see and take some encouragement and some optimism from things that are working at what is otherwise a pretty bleak time, if we're honest about it. We're not on track to meet the Paris temperature goals. We're not living sustainably on the planet. We haven't heeded the lessons that are there for us, certainly in a country like Australia, from our First Nations heritage, which did live, those peoples and cultures did live sustainably in Australia for tens of thousands of years. So we need to take heart from the things that are working, and I think in Australia, I'm going to point to just a few examples before allowing our panellists to speak more directly about the work that they're engaged in. One of the good things is the CEFC, the Clean Energy Finance Corporation, the world's largest green bank. It has done a power of good in Australia, and it continues to do that work. The other things more recently include the creation of the nature repair market, which will mean that through a high integrity certificate system, investors can support restoration. In some cases in all cases it will have environmental condition and biodiversity benefits. In some cases it will also have carbon abatement, carbon fixing aspects as well. And it will tie in with the Australian carbon credit unit scheme that we've had in place for some time. And again, some of the methodologies that operate, from which people can derive ACCUs, have direct environmental benefits and biodiversity protection benefits in addition to what they're doing on the carbon front. So we see that the nature repair market will kind of amplify the work that the ACCU scheme is already doing, and that it will, in some cases, also join up the opportunity to engage our First Nations knowledge and practices that have been with us for tens of thousands of years. Just one example, the Savannah Fire Management Method. It's improved Indigenous fire management over 24 million hectares in Northern Australia, Northern Australian Savannah, abating 1.2 million tonnes of carbon dioxide a year, and 74% of the carbon credits produced by the Savannah Fire Emissions Avoidance Method and related ACCUs are generated by Indigenous carbon businesses. So that's a success story. But I won't take up more of your time. I'm going to give way to our fantastic panellists. Thank you for coming along to the Australian Pavilion today.
Thank you, Assistant Minister Josh Wilson, for that, and very kind remarks about the CEFC. I thought I might just talk a little bit about the work of the CEFC in carbon markets and natural capital, just for a few minutes before welcoming the team, the panel up on stage. So just to sort of recap, so the Clean Energy Finance Corporation is, it was established by the Australian government some 13 years ago. For many years had 10 billion Australian dollars to invest in the clean energy transition. More recently, under the current Labor government, got a further 20.5 billion. So, as Josh mentioned, we are now at $30.5 billion of investment capacity or capability, which makes us very much the largest green bank in the world, something that I think Australia should be very proud of. In terms of our, we invest right across the economy. You were probably very well known, or most well known, for investing in wind, solar storage, and more recently transmission. So Australia's trying to get to 82% renewables, and we'll need to build thousands of kilometres of greenfield transmission. So we've got an additional $19 billion to do that. But as well as the electricity sector and decarbonising that important part of the economy, we have been investing in harder to abate sectors, and one of those, of course, is agriculture and natural capital. And just some of the examples of investments that we have been making, we began by investing in cropping and pastoral funds. So we do direct investments, but we also invest in funds where we have, we see managers with particular expertise in Australia, and those first two funds were part of the Macquarie Group, so Macquarie Asset Management, and the second of those, a pastoral fund investment, was managed by Paraway Pastoral Company. That's sort of, again, part of the Macquarie Group. We've also invested in clean tech companies in this space, and a couple of examples. Downforce, a company that is a measurement company, measuring carbon credits out there, an Australian UK-centric company, and another one, Loam Bio, which is a company that's developed a seed-based technology to retain water and carbon in the soil, and has had some success with some very high-profile investors. So it's a very broad spectrum of investments. In addition to that, we've invested alongside large international institutional capital. The French Canadians, CDPQ. We've invested in a large agricultural fund that's managed by Gun Agri, a well-known Australian fund manager in this space, and that capital is being used to improve the carbon emissions profile of properties through regenerative agriculture and the development of Australian carbon credit units. We've also made recently our first investment in the forestry sector, and we're going to hear a bit more about that from our friends at New Forest. So we have one of the panel members there. But we invested in a fund, the Australia-New Zealand Landscape and Forestries Fund, which through the reconfiguration of the fund and the sort of migration from hardwoods to softwoods, and the way those forests are being grown, will generate up to something like 1 million carbon credits over a 10-year period. So a very exciting investment for us. That's look, and I think that gives you a bit of a flavour of the sort of things that we're doing. All right. Well, without any further ado, I'm going to welcome up my panel here. Jeffrey Cito from New Forest. If you want to take a seat, I'll sit here if you like. So it's up there. Sky Glenday from Climate Friendly, and Alex Lewis from Qantas. If you take a seat there. Jeffrey here is a Senior Managing Director of New Forests, and they're, of course, a leading player in investing institutional capital in the forestry sector. Climate Friendly, which Sky is the co-CEO of and has already been speaking here at the Australian Pavilion, Climate Friendly, of course, are one of the larger and very highly regarded carbon farming groups working in regional and rural Australia to generate carbon credits from improving emissions and the reduction of emissions, and Alex Lewis, as I say, from Qantas, who is head of carbon markets. So very much look forward to my conversation here. I think what I might first start doing is I'll start with Jeffrey, just to tell us a little bit about their organisation's work in this space, in terms of what they're doing and in the interface between carbon markets and nature-based solutions. So I'll start with Jeffrey and we'll go across the panel. Thank you.
Thank you, Ian. So my name's Jeffrey Cito. I am responsible for New Forest Emerging Markets business, which includes Asia and Sub-Saharan Africa. Certainly can talk to some of the Australian funds as well, but my perspective is a little bit more on the Asia and beyond side. So as we think about the role of nature-based investments and the carbon markets, we have our funds invest into we have three main mandates, or three goals that we look at. The first of that is, when we invest capital in the emerging markets at least, what is our contribution to the circular bioeconomy? And so that takes into account the use of timber as the ultimate renewable resource. It takes into account sustainably managed plantations and intensively grown as displacing natural forest conversion. And it takes into account the use of timber as a substitute for high emission building products, so the built environment, such as concrete and steel. So timber plays a big part in our investment cycle. The second part of that is, how do we look at impact, and how do we generate impact with intentionality? And the three types of impact we look at are climate change mitigation, biodiversity, and life on the land, or livelihoods. And so we actively target those alongside generating a financial return in our funds. The third is shared prosperity. And what shared prosperity means is that we regard the interest of all stakeholders, which include the communities on the ground, as well as our investors, who are pensioners and nurses and teachers, equally. And so there is a shared prosperity that we want to make sure that everybody's interests are looked after. And the approach we do this is through a mixed landscape approach. So we consider the whole of the landscape, and invariably you'll have elements of that landscape which will include sustainable timber production, processing, biodiversity and conservation areas, riparian boundaries, community elements, and so on and so forth. And the ability to maximize the use and value of that landscape, and to use every square centimetre of that to optimize it, gives that land a value. And that value, and in properly valuing that land, there is an ability for that land to stay as it is, including those conservation areas, versus other types of land use, which may include palm oil or agriculture or other things. So those forests essentially stay intact. So in Asia, what we have is a blended finance structure, and that's how we fund all this, where we have identified certain pools of capital that want certain outcomes, and that includes impact, but also financial returns. We do this through a different class share structure, but essentially it's a financial, it's a concessional capital model where we have foundations alongside sovereign wealth funds, alongside corporates, and even some other large institutional capital. So I'll stop there as an introduction and move on.
Thank you, Jeffrey, for that. I'm going to hand it over to Sky.
Thanks a lot, Ian. So my name's Sky Glendale. I'm the co-CEO of Climate Friendly. So we partner with land managers in Australia to urgently store carbon, repair nature, and advance reconciliation. We work under, I guess, two main regulated schemes in Australia, the Carbon Farming Initiative and the New Nature Repair Act, which is just getting started. So we've been working sort of through voluntary methods in that space until now. We've already supported development of over 160 carbon farming projects in Australia over the last few years, and they cover around 10 million hectares of land and have generated over 30 million tonnes of abatement to date. So we've got quite ambitious goals to scale that up and to have established partnerships by next year that will deliver 150 million tonnes of abatement through the life cycle of their projects. So we're a good portion of the way to achieving that, and hope to sort of keep scaling up our partnerships, and we're in the process of setting our next 2030 goal. So we hope the government's goals will be as ambitious as ours are. One of the key roles, I guess, that we play is trying to structure innovative partnerships that can actually unlock the finance flows to help the different kinds of land managers that we work with get started, because that capital constraint is often a key issue. So we work with everyone from sort of mum and dad farmers to bigger agricultural organisations, traditional owners, forestry organisations, conservation groups, government. So we've got a big kind of cross-section of land managers and partners that we work with. And maybe just a key example of some of the work we've done that brings that together in partnership with WWF Australia. We have a koala-friendly carbon initiative that we've been working on, and that's really blending the environmental planting carbon method in Australia with nature repair koala habitat condition. And the two things fit together really neatly to, I guess, go above and beyond standard environmental plantings. In Australia, just as an example, in a standard planting, you could have about 4 species of trees and quite sporadic kind of coverage. But in a koala planting, it's well over 25 species and a much higher density per hectare to get the kind of dual carbon and environmental outcome. And then partnering with other Indigenous entities on the ground to do a lot of the land preparation and planting and seed nursery work. So that's just a practical example of how we're bringing those things together on the ground.
Thank you, Sky. Very good. Alex, over to you.
Thanks, Ian. And for those who don't know me, my name's Alex Lewis. I'm the head of carbon markets at the Qantas Group. So we're an airline based in Australia. Maybe first, though, just before I talk a little bit about what we do, I guess I wanted to talk about one of the things that we've seen as really important this week. Whether you've been at the Singapore Pavilion, whether you've been at the World Bank Pavilion, whether you've managed to make your way over to the Japan Pavilion, or really any of the pavilions, particularly the countries based in Asia, is you will have heard them talk about the importance of carbon markets to mobilise private capital to drive investment into projects on the pathway to net zero. And I think it was heartening to hear Singapore's ambassador for climate change, Ravi Menon. He, in his own words, he said that he doesn't see a pathway to net zero without carbon markets and without carbon credits. And as a tool to mobilise finance, it's absolutely critical to where that they want to get to. And we know that private sector finance is going to be so important to meeting NDCs, particularly in all countries, but particularly in the developing countries. And I'm sure on Finance Day we're going to hear a lot of numbers quoted, but the UNFCCC has the numbers at $6 to $7 trillion cumulatively is required by 2030 to keep developing countries on track to meet their NDCs. Other estimates have it at 13 trillion, which is the combined GDP of Japan, Germany and India by 2030 to keep NDCs on track. And we're at 2025. So I think that's the scale and that's the time frame in which we're having this discussion today. And in the context then of a mechanism that can drive finance into these projects, carbon markets could really be considered a fundamental part of how countries are going to meet their NDCs. And we can see that trickling down into domestic policy. In Australia, we have the safeguard mechanism leveraging carbon markets. Internationally, we have the CORSIA scheme. For those who don't know, that's the International Aviation Community's commitment to address climate change and address emissions in that sector. And so I think bringing it back to Qantas then, you know, we understand that it's widely acknowledged that aviation is a hard to abate industry, but we have a responsibility to do what we can with what's available now. And it's a reality that our pathway to net zero is not going to be a linear one, and we're not going to be able to achieve it necessarily alone. And at the moment, what we're doing on that pathway is we're working with stakeholders, we're investing directly in projects with partners to grow a sustainable aviation industry in Australia and overseas. We're also looking at operational efficiency on our aircraft to directly reduce emissions. But we also consider it important that we invest in high quality and high integrity carbon markets on our pathway to net zero to help us achieve our interim targets on that journey. So in that context, we can contribute to national and international emission reductions by driving finance into projects in other economic sectors that can reduce emissions and have a whole range of other benefits. And bringing it back to this panel, I guess, one of the exciting things is we have discretion in how we do that. So we get to decide where we invest. And one of the things we're continuing to learn is the amazing benefits that these projects, the people developing these projects, the landholders, the traditional owners, the amazing contribution that these projects can have to nature and biodiversity. And so while it is challenging to operate in the carbon market, and it's a minefield for a corporate to navigate this market, but despite that, it's still really exciting to be looking at investments in nature and carbon, looking at investments that can help improve integrity, can bring new technology and result in these biodiversity outcomes. So in my position, feel quite lucky working for a major corporate that's committed to making significant investments in really important projects that are helping to create value around nature, help create value around restoration of ecosystems, help create value around traditional knowledge that's always been there. And then the bonus is tying that back up to meeting our net targets and helping us on the pathway to net zero.
Thanks, Alex. Just while you've got the mic, Qantas has obviously publicly stated it's got a $400 million carbon fund. It'd be interesting just to hear what the aspirations and ambitions of that fund might be, what you're looking at, given that Qantas is kind of there in a very deliberate way, putting its own capital into seeking out offsets and new technologies for reducing emissions.
Yeah, thanks, Ian. So the Qantas Climate Fund, which you note, is a $400 million fund that we've put together, and that's us putting aside capital to invest into decarbonisation opportunities. But an important distinction that I'll note is it's not just for carbon markets. In fact, the majority of that capital is actually being used to grow the sustainable aviation fuel industry in Australia and overseas, as I mentioned. So it's a two-pronged fund, both to address our direct emissions, but then we have a portion of that capital set aside for us to invest in, and particularly in nature-based projects in Australia and overseas. One of the reasons that we put that fund up is as a corporate buyer who knows that we will require potentially a significant amount of carbon credits, and we want to invest in those projects, is that we can't just sit on our hands and wait for the particular projects that we want to see in the market, that we want to invest in. We actually have to put our capital forward to try and incentivise these projects in the market, and that's exactly what it's designed to do. So we're investing, I guess, at the high end of the spectrum around perceived integrity. We're looking at environmental plantings projects in particular. We're looking at diverse species planting, about integrating these projects with agricultural activities so that we continue production on the land, but also we can bring some benefits around nature as well.
Thanks, Alex. Just thinking about some of the big issues here at COP29 in relation to this particular topic, and I think quite remarkably, Article 6, which has been debated at the many COPs along the way was gavelled, as they say, earlier in the week, day 2, I think, of COP29, which I think is a very significant step and will have implications for carbon-based markets, Australia and Asia and other markets. I wondered, Jeffrey, if you might sort of give us a bit of a view about, what are the implications of the Article 6, the fact that it's been agreed to at this stage, and the form of it, and how you think it might play out across markets.
Thanks, Ian. And it's a real topical thing right now, and a lot of people are discussing it. Specifically, there's 2 parts or 3 parts to Article 6, but the one I'm talking about is Article 6.4. And that is a methodology for carbon credits or carbon offsets under the UNFCCC. And 6.4, that's just been gavelled, includes the concept of a nature-based credit. It also includes other methodologies like carbon capture and other technology-type solutions. The recent announcement from the supervisory board around nature-based is that there are certain provisions in there that make potentially, and without being too controversial at COP, potentially make nature-based projects unviable for financial investment. And that, without going into too much detail, revolves around some of the buffers that we need to set aside for events of leakage and other things, but also the monitoring and the verification. And so I think this is an issue because they're talking about inclusion of nature-based, so everything looks good, take the win, and we're at the 3rd or 4th COP now where Article 6 needs to be resolved. But what we want to do is ensure that we build in that ability to have that industry consultation post-COP29 to be able to not reverse, but have calmer heads prevail. Because land use and land-based and nature-based credit is 37% of the solution in a 2030 world. That's about 15 to 18 gigatons of carbon. And what we're trying to say is make this viable enough to be included in 6.4. Now, in the Australian context, it's less relevant because you have a compliance mechanism, but the rest of the world needs to be included in that as well. And nature-based credits is the only technology that we have right now that can sequester carbon at scale in a world we live in. And carbon capture is a very nascent technology. It will get there, but we need it all. And everything else that you can think of as well, if we're going to achieve where we get to. So I've been talking to the Australian negotiator. We've been advocating with Singapore, who have accepted nature-based credits into their carbon tax scheme. And I think you need to have that foresight for investors to be able to invest into the space, because ultimately, to unlock the capital you need for carbon finance includes the ability to generate an economic return so that the CEFCs are able to generate a return for their policyholders and their governments. And so it needs to be more than just inclusion. They need to think about the viability of what they're saying. So I get it. We need to take the win, but let's work on it over the next year, and hopefully we're not talking about this next year.
No, thank you for those thoughts, Jeff. Maybe I've just put the sort of the question in a way to Sky in the context of the Australian, ACCU market, and the potential implications of Article 6 to the kind of Australian market. I mean, at the moment we've got a relatively limited number of methodologies that are being used to generate credits around environmental plantings, and that's about to be finalised, savanna burning. Will this help in some way? Is it likely to have an immediate impact in Australia? Also interested in your thoughts on just the international transferability of Australian credits in both directions, if you have some thoughts on that.
No, thanks, Ian. I think Australia has a real opportunity here to use over a decade of experience in implementing this. So it's unlikely that we would directly be using Article 6.4, but we have, I guess, all the mechanics and governance set up in Australia to really inform the next layer of guidance. And so I think, as you sort of said, Jeff, that getting this decision is great. We need to move forward, but a decision that can't be operationalized then will leave us nowhere. Like for too many years, nature-based solutions haven't been an investable asset, and that's the whole goal here, to transition that. And so in Australia, we now have a well-established scheme with over 2,000 projects. You know, we're generating on average 20 million tonnes of abatement every year. We have the sorts of permanence buffers, the sorts of monitoring mechanisms that are being debated in the guidance. And there's a real opportunity to share that knowledge into the next phase of operational guidance and make sure that can work in other countries around the world. I think to your question, Ian, of, you know, how does this relate about import, exports and sort of market connectivity? It's not really okay to have one set of rules for a country like Australia and a different, harder set of rules for a developing country that then can't participate, because the key goal of these mechanisms is to have that uptake and finance transfer in developing countries. So we need to make sure they have high integrity markets, and that we share the lessons around the elements of our scheme that have been successful, the ones that we've been improving. It is a continuous improvement exercise, but we have over a decade of doing this, and we have all of those mechanisms operational, so we can inform how the buffers are set and how that monitoring occurs, and that will actually allow us to take that step change. And if the guidance doesn't sort of learn from those lessons, then we won't find uptake around the world, and we desperately need it, because this is the decade of action, and nature-based is critical to getting that outcome.
Thank you. Maybe just kind of bringing it back to the sort of projects that we're looking at in Australia. I wonder whether, Alex, I might ask you to talk to today the sort of projects that you might be looking at, or one that you've done recently that potentially has an element of, you know, nature-based element to it, why you were attracted to that, maybe the economics of it, and the, you know, the biodiversity angles, if they were relevant. I'd be interested to hear.
Yeah, so we have already, in fact, this year deployed capital into the Silver Capital Fund, which is a fund set up in Australia, and we've invested in that fund with other corporates. The attraction for us in that particular project was the fact that it is a carbon project looking at diverse native plantings that are integrated within agricultural productivity. So we think that's important, to be supporting regional communities' agricultural activities, but also helping provide that finance to support them to do that in a way which helps restore nature and brings some of the benefits around biodiversity and restoration that we want to see. And maybe if I can just go a bit further on that in terms of why we're actually looking at nature-based solutions. And it really came out of a study that we did last year, where we looked at nature risk and opportunities across our operations and up and down our supply chain. And the motivation for that was it's hard to act on nature, and it's hard to reduce your impact if you're not understanding what that impact actually is, and that you're not reporting on that as well. And so, similar to carbon, we see an opportunity to reduce our operational impact on nature, both within our operations but outside our operations as well. And that's why we're seeing this mix of carbon and nature projects, and our focus on that is this is one opportunity where we can lessen that impact on nature, and of course contribute to restoration in Australia, but also in other countries as well.
Thank you, Alex. And it's kind of interesting, that intersection between the generation of a carbon credit and carbon markets and biodiversity offsets and other things. In some of the work that the CFC is doing, particularly around the build-out of transmission projects, which are so essential to capture renewables across Australia, there's an enormous cost to the biodiversity offset side of things. In fact, hundreds and hundreds of millions in some cases that we are kind of investing in, but they don't necessarily come with a carbon, a carbon credit. They may just be an offset requirement of the particular project. So where we can kind of bring those two elements together, we're going to get a great deal more investor interest. I thought I might swing the conversation towards investors and expectation from the investment community, and ask Jeff, who of course is about to close his fourth fund with something like nearly $700 million of capital from Australia and international investors, looking at the positive nature outcomes and carbon outcomes of your forestry fund. Just to hear about challenges in getting Australian investors into these funds, what's attracting international investors, why are European investors so kind of more progressed than the Australian investment community, and just kind of hear what's bringing people into your funds.
Absolutely, and thanks, Ian. So, New Forest manages about $8 billion US dollars of funds under management, and that's 39 of our clients is about 80% of that. Most of those clients come from Europe. They're European and Canadian investors. And we think we've been talking to Aussie super funds and the Aussie institutional capital for a very, very long time. I think part of it is, forestry hasn't had a good reputation in the past, which was the opportunity for New Forest when taking up all the MIS schemes and being able to rehabilitate that. But I think part of it is that Europe and other external jurisdictions have they're much more progressive in the way they think about sustainability in the environment. And if you look at the EU taxonomy, if you look at nature-based financial disclosures and these sort of new reporting requirements, forcing companies and institutions and financial institutions to become much more transparent about the risks on their balance sheet, not just relating to climate, but to nature. And I think that's an important point because it's not just about the carbon, as the Assistant Minister said earlier. It's about the biodiversity value. It's about the livelihoods and communities. And to concentrate on carbon in this COP is not to me within the spirit of things. If you look at all the pictures outside, they're of nature. We're not talking about carbon capture machines at the moment. And so I think within the spirit of that, and the Europeans, through this disclosure and regulatory disclosure, are now forced to show the consumers, the regulators, and everybody else what is that risk they have on their balance sheet in relation to nature. And so they're much more progressive in terms of SFDR, the taxonomy, and we report against all those things. We've tracked 80 plus sustainable landscape investment metrics. And what that does for a European investor is that when they invest into our funds, they can port the reporting straight onto their balance sheets, which is the precursor to natural capital as an asset class, which we think has to be the end game here. But for now, it's easy for them. They're making these disclosures. The people who consume their products are now much more informed about purchasing a sustainably grown or a sustainably sourced product. It goes all the way down to the consumer and all the way up to the regulator. And I think that's driving a lot of change. And Australia is starting to introduce some of these disclosure requirements, and that's very positive, but I think we need to do more. And this is a chance for Australia to take the lead on some of these things.
Thanks, Jeff. Yes, I think there's a bit of an evolution to take place. In turning sort of to the buyers of carbon credits in Australia, it's invariably in the first line of people who have a compliance obligation, and Australia, as we know, has the safeguard mechanism looking at driving down emissions in the industrial sector, predominantly the industrial sector. I wonder, Sky, if you could kind of give us a bit of a feel for is that the ongoing interest in buying ACCUs in Australia will continue to be from that market? Is there a pool of sort of institutional capital or financial innovators that are looking maybe to also invest in that, and is that market changing?
Yeah, look, I think we're about to go through probably the third evolution of the market. That we started with the Australian government as the primary buyer to stimulate this market, and now we've moved, as you said, to the safeguard compliance mechanism as the primary buyer at the moment. in that space, and that is really an offset focus. But what the carbon farming initiative is a unit of carbon, I guess, a metric of reduction, and not necessarily an offset. In Australia, we still have 20% of emissions coming from the land use sector, and I think the next evolution we're starting to see now is a result of the disclosures that Jeff mentioned, that basically across the spectrum of the early organisations that are needing to report on natural capital impacts and climate resilience as the sort of first leading disclosure, they're really starting to think about their supply chains, and Qantas is in that mix, as Alex has been sort of talking about there. And so people are starting to look at insetting within their own impacts, and I guess that's in the financial institution sectors with lending, it's in the agri-business sectors with their supply chain production, and it's across broader, the full suite of impacts. You mentioned energy transmission, like we have impacts on natural capital across so many sectors in the economy, and as people are starting to think about that, I think we're seeing the next evolution, and it won't all be about safeguard mechanism compliance. So for us, that's the key driver of why we need more methods in Australia. There's been a focus on AccuSupply being a thing that the safeguard mechanism is going to purchase, and I think that's quickly shifting with others across the economy looking at their disclosures and their impacts and looking at how they can inset. So we are about to go through in the next few years, hopefully the next wave of change as to who the main source of demand is.
Yeah, it's interesting, isn't it? Because I do see big institutional capital, whilst not directly investing in carbon offsets, nature-based projects in Australia, have been investing in carbon farmers like yourselves and Green Collar, really big players like KKR, Ontario Teachers, the private equity world, very kind of working with almost the picks and shovels of the sector rather than kind of going directly into the projects, which is interesting. Alex, just kind of over to the aviation sector. I just wonder what trends you are seeing more broadly in a global sense with airlines, Qantas as well, in terms of their net zero aspirations and what they're then doing in terms of investing in projects around the world. And I'd be also interested in where you think SAF is heading. I know that's because it's obviously got significant agriculture and nature implications. So maybe just have some thoughts around that.
Yeah, definitely. I think probably the biggest thing driving the aviation industry to invest in carbon projects of this nature is the CORSIA scheme. And so that sits across all the aviation industry, and there are strong targets for reductions that do require the investment into other sectors to help meet those particular targets. There's a lot of the current negotiations going on at the moment, particularly in the rooms around here, do have relevance to that scheme, particularly in the way that host countries are dealt with, and making sure that they have the confidence and the understanding and the capabilities to be able to make decisions on where their emission reductions go. So there is still quite a bit of detail to be worked out in CORSIA, but I think a number of airlines, including us, are ready to move in and start investing once the rules become clear. I think, more generally, I think it's not just us looking at nature-based solutions. We are, as Sky and Jeffrey said, we're seeing a lot more corporates looking at their nature impact. There's TNFD that's on the horizon. So corporates are wanting to understand their impact on nature and on those particular risks. I think for internationally as well, other corporates, other airlines, particularly looking at Australia, is fertile ground for investing in carbon projects. We have a large amount of the carbon market is attributable to nature-based carbon projects, and there's still a significant amount of potential there. We also have, a strong regulatory system backed by government. We have a capable public sector that does provide a lot of confidence to international investors to look at Australia and the projects that we're developing here as well.
Thank you. I thought I might hand it over to the floor and see if we've got some questions for the panel. We've got a roving mic here, so our first question.
Good afternoon. My name is Ray Geesens from Quantum Commodity. I've got two specific questions for Alex, if I may. I feel we're picking on him, but first one may be easy. You mentioned at the beginning that you look at nature-based projects both in Australia and abroad. Is there maybe some internal guideline that you can shine some light on whether you prefer Australia or whether a certain section needs to be in Australia, or you just look at the integrity of it?
Yeah, obviously we have an internal integrity framework that does have some impact in where we invest, but broadly more, I guess, from a strategy perspective, a lot of the decisions already made for us in terms of a lot of the projects that we'll be investing in, direct investment or purchasing, is dictated by our compliance under, when in Australia it's dictated by the safeguard mechanism, and then for Corsia, obviously international. Australian-based carbon credits aren't eligible under Corsia at the moment, and not sure if there are any plans for that either in the future. So that does kind of naturally just split where our investment goes in Australia.
And then the second question, if I may. As an airline, of course, SAF, we touched on it, is very important. I think the IATA says 60% of the net zero target should be with SAF, with emissions a rather small bit. SAF's obviously a lot more expensive than jet fuel. It's twice, 3 times the price. It looks like it may be like very expensive for a time to come. So assuming that SAF will be like twice the price of conventional jet fuel, would that mean that an airline like yourself would shift more into offsets? Or will you just bite the bullet and hike ticket prices? Or how do you deal with a potential high price of SAF versus a carbon market?
Unfortunately, I'm going to probably disappoint you with the answer, because I'm the head of carbon markets. We've got a whole team that's dedicated to SAF and sustainable aviation fuel, and they're much better placed to answer that question. But I think, we consider one of the most important things is actually having the supply of it in the first place. And it actually triggers me to answer the part of the question that Ian asked around the impact of investments like that on nature. And it's one of the frameworks that we have internally as a nature risk assessment. So we're looking at, when we're looking at investments in SAF and we're looking at those particular projects, we have to go through a set of criteria that dictate what is the actual impact on nature, on feedstocks, on agriculture, and we have to take those considerations into place. And so there's not a wealth of SAF supply out there at the moment, and that's why we've got the climate fund that we have, and we're trying to direct capital into investing in growing that market. But I can chat with you offline, and I can try and get an answer to your more detailed questions.
Hi, my name is Cedric Jelu from Ghana, and I represent the African Youth Commission. We do know that carbon market and carbon finance is an emerging field. My concern is, how do we bring young people along in terms of training, in terms of capacity building? And this goes to any of you who feels comfortable to answer. Young people want to know, where are the programs, where are the opportunities, where are the courses, how can they leverage on any platform to come along? They don't want carbon finance to take off 10 years before they come along. They want to come along just as it moves. Thank you very much.
Thank you. Sky, sure.
Yeah, look, I think we have a really important role in Australia to play with sharing the experience we've had domestically. In a former life, I was a Red Plus UNFCCC negotiator, and now I've been trying to get projects live in Australia, and I learned how hard that is to actually deliver it on the ground. And if we've gone through that learning experience of actually operationalizing it over a decade in Australia, I think we can share that. I'm super conscious that every country around the world will be unique and different and need to operationalize it for their context. And I spent sort of 4 years working in Indonesia in our embassy there, working with them on what that meant and what was different from what we can do in Australia and what Indonesia does. But we need to have those exchanges. We need to have people coming and seeing the different project types that we have meeting our regulator, understanding the compliance mechanisms. Australia and Africa have a lot in common, that we have big savanna areas and similar methodologies. We can have methodology exchange there. So doing that in a really structured, deliberate way is a really important next step, and hopefully something that we can do if we host COP in 2 years' time, and we've got great opportunities in Brazil next year as well, you know, to iteratively build that, not just have the talks here in the conference, but go out to the ground, see how things are working, and have some of that practical dialogue and exchange.
I might just take a stab at that. So we've got an African fund based in Nairobi. We have one asset in East Africa, and that goes across Tanzania, Uganda and Mozambique. I'd love to come to Ghana at some stage, and West Africa is very high on the list. I think that capacity building element of what we do is crucial, and that knowledge transfer, as Sky said, from the markets where we've developed the expertise. So we've been capacity building in Asia for a long time around those voluntary markets. There are lessons to be learned from the compliance schemes as well, and the methodologies. But the best way to do it is to make the investment and to develop the projects, which is what we're doing in Mozambique right now. And I think then be able to attract the youth, or just capacity building in general, localizing management, having that knowledge transfer from your other parts of your business is crucial in order to be able to build up that knowledge base in the various countries. And we bring people across, we run programs and everything that we do there. So the best way to do it is to try and make those investments and develop those carbon projects.
Thank you.
My name's Dominique Hogan-Doran. Question, I think maybe to Jeff and to Ian. The Australian superannuation pool of capital is 3.4 trillion in size. What are the barriers or prospects of that pool being deployed into carbon finance? And I think you mentioned some hesitance in the Australian group. I'm a former director of an industry super fund, so I'm interested to see where it's heading.
I might start, then you can add, Jeff. Yeah, I mean, it's the great, in some ways it's the holy grail, the Australian superannuation sector. As you say, it's a multi-trillion-dollar sector. Australia and Canada are the two countries that have, I think, created these enormous pools of potential investment opportunity through that system. And the big super funds, I think some of the challenges, because they're so large, they need to do very significant transactions. If you turn up and said, here's a $10 million nature-based carbon project, their eyes would glaze over. They'd say, what about if it was, it's 250 million, that'd be better. So I think scale is an issue. I think the liquidity of those projects, they obviously favour listed securities, fixed income, where they can kind of very quickly liquefy investments in that way. So I think there are a couple of challenges. The other thing is, where does it sit? They're quite rigid, these big industry funds, super funds. They've got their equities, fixed income, property, buckets, if you like, and then you come along with interesting climate finance investments. They sometimes struggle to know where to put you. Are you in the infrastructure? Are you in unlisted? Well, you will be. So there's some of the initial challenges. There's certainly a lot of or interest from some of the more progressive ones, but just closing that gap I find difficult.
And it's that ability to deploy large amounts of capital. And I remember I was a former infrastructure banker as well, and until government started privatisations, the Victorian power privatisations in the 90s, that generated that asset class, and infrastructure used to be in the same boat as that. Nobody knew where to allocate. The other thing, I sit on the investment committees for all our Australian funds, and just underwriting the carbon curve. In the voluntary markets, we don't even have price discovery. You have Reputex or whatever it is that they look at. And it's just, there is a reluctance from industry super to rely too much on the future value of potentially what that carbon looks like. So it looks very much now still like a land and trees game, unwilling to underwrite large amounts of carbon at the price, getting better at it as price discovery, but we do need more of that ecosystem. And I always advocate in any carbon markets, when you have carbon as more of like a financial product, where you have a proper curve, you can hedge against the curve. There are market makers, there are ratings agencies, and you make it look like a bond. So when I buy a credit, I know exactly like when I buy a share of Apple, what I'm getting. Once that ecosystem develops, and it is developing, that's when you start to have more confidence about being able to underwrite that carbon. So the bulk of the super funds now still look at what we do as forestry and timber production and processing. But it's getting better, and those disclosure requirements and what have you are all starting to come through now.
Thanks, Jeff. I think we've got time for one more.
Hi, thank you all so much for this. My name is Mira Kelly Fair. I'm a PhD student at Boston University who uses remote sensing to look at nature-based solutions. My question is for Jeffrey. So obviously, my question is particularly about valuation. We've talked a lot in this about valuation based around climate mitigation. However, I was hoping that you could talk a little bit about how you are doing valuation for climate adaptation in your forests. So for folks who don't know, that's things such as using forests as a buffer for urban areas due to the increase in storm frequency and intensity that we're seeing, or from erosion as well.
Yeah, so when in terms of where we sit in Asia, at least with our blended finance and the generation of positive impact outcomes for communities, and as a result with that livelihoods and adaptation, when we make that investment decision, we build all of those things into the investment thesis. So as we're thinking about potentially communities and adaptation, not necessarily as buffers or what have you, but also giving to the livelihoods of communities and things, that gets built in at the outset. So you get the most efficient allocation and value for money of that capital. And so what we do in the investment process is, your ESIA, we look at economic baselines, we identify the most vulnerable communities, we do free, prior and informed consent continuously. And those most vulnerable communities are the ones we then start first with our projects. And that adaptation piece could include agroforestry, so they have a subsistence level of food and farming. It could include assistance around community outreach or community forestry projects where they grow and own the trees and have the option to sell to us or anywhere else, whether they can get a better pricing. And so those sort of things help to develop that livelihoods. We have to do everything at scale. And one, to affect true climate change mitigation, but two, it doesn't make sense for us to do some smaller projects. So I hope I've been able to answer some of that, but maybe Sky, you want to talk about that?
Yeah, if I could just add, I guess maybe a smaller project level example, that in the way we're working, we start with a natural capital assessment of the land to really work with the land manager to decide, I guess, the optimal project design. And that gives us a good baseline of them against the region and them against themselves as the project kind of progresses. And that really informs, where we're planting. So the koala projects that I mentioned at the beginning, they're happening in a region of Australia that was really badly impacted by floods. And a lot of the project planning for the first pilots we did there happened just after that flooding, and the land managers were watching the water flow in creek beds that have been eroded. And so a lot of those plantings have occurred on the riparian area